let's just start with what happened last week.
So what happened last week was on Monday, there were two things happened. Corporate tax payments, September 15th, and settlement of Treasury auctions. And both those things basically moved money from the private sector, from banks, to the Treasury's account at the Fed. That drained bank reserves from the system. And later in the day, on Monday, you start to see quite a bit of upward pressure on repo rates. And that spilled into Tuesday. In fact, on Tuesday, the pressure was significant enough to actually push the federal funds rate, which the Federal Reserve targets. It had a range at the time of 2 to 2.25%, pushed it to 2.30%. So the federal funds rate was actually trading for one day outside of its range.
We're trying to work out whether it was a confluence of events, things happening all at the same time, temporary, idiosyncratic, or something more structural, whether the central bank has got to find out the appropriate level of reserves. Is that what we're still working through, Bill?
Well, there was a structural underlying issue, which is the Fed has shrunk its balance sheet over time. Currency is growing. The Treasury's cash balance at the Fed is growing now that the debt limit issue is being resolved. And so as a consequence, the number of reserves in the banking system has been shrinking. And this is tricky because the Federal Reserve doesn't really know how much bank reserves banks need to satisfy the new liquidity coverage ratio requirements. These are liquidity requirements, and how much demand is going to be generated by the fact that interest is now paid on reserves. So the Fed, for years there was plenty of reserves in the system.
Right.
But now they're getting to the point where reserves demand is equaling reserve supply. And so if there's a little bit of a shock to the system, that can put upward pressure.
But you just said the heart of the matter. This is the trust market, a short-term paper. You worked for years in the trenches of this with your Goldman Sachs market experience over to the New York Fed with Geithner, and you just said it. The Fed doesn't really know. That the Fed doesn't really know, does that potentially affect trust in this important
No, I don't
market?
think so. I mean, I think we always knew that there was some desired demand for reserves, but we couldn't observe how much that demand was because there was more than sufficient reserves in the system. So there was always going to be a point where the reserve supply shrank to the point that we would see upward pressure on short-term rates. And when we reached that point, the Fed would know, what do they need to do? They need to add more reserves to the system. And that's what we saw over the past week.
One complaint we have had is that they were late. They weren't quick enough. What's your response to that?
Well, in the scheme of things, maybe one day would be nice if they had responded maybe a little bit more quickly. But in the scheme of things, this is an event for markets. It's not an event for the economy at all.
But you know what the narrative is that's emerging over the last couple of weeks? In fact, it's been emerging for the last 12 months, Bill, is that you left, Simon Potter reportedly was squeezed out, and this New York Fed is different under Williams than it was to you. That this New York Fed isn't as sensitive as what's happening with markets as it was under you.
I don't accept that.
Well, defend John Williams and the Fed, please.
Well, we knew that there was going to be some point where reserves had shrunk to the point where demand for reserves was going to equal supply, and when that happened, we're going to see some upward pressure on rates. That's what happened that last week. No surprise there. The other thing that people I think don't really appreciate, it's not one person at the top of the Federal Reserve that does its thing. There's literally hundreds and hundreds of really qualified people that execute monetary policy on behalf of the Federal Reserve. And where are we today? We're in a good place. Repo rates are now back down to where they should be. The federal funds rate is well within its range. So mission accomplished as far as
John and I talked to Willem Bouter today of Citigroup. That's a small bank. You may be familiar with it. and Bill Dudley, Bouter said the same thing. Everything's fine. It's a kerfuffle. There's a sizable part of our Bloomberg surveillance audience that flat out are worried, or they even don't agree with the idea that the balance sheet of the ECB, the BOJ, and the Fed is moved from X up to 14-some trillion dollars. They want a reassurance that that is a good place to be rather than the nostalgia of moving back to a previous balance sheet regime.
Well, if we move back to the previous balance sheet regime, what you'd have to do then is the Federal Reserve would have to intervene massively in markets on a daily basis, and I don't think that's a good regime. In the current regime, if you have enough reserves in the system, you don't have to do anything day to day. The interest rate you pay on excess reserves essentially sets the level of money market rates. The Federal Reserve, the federal funds rate trades within this range, and you're done. So it's a much simpler regime.
Am I right, John, that we need like 400 billion is the plug-in number right now, or 380 billion?
Well, people don't really know exactly how much reserves you need to have sufficient, but I think the Fed is going to build up a little bit bigger buffer. They're doing it by doing repo operations, and I think in the fullness of time, there's a prospect of two things happening. Number one, they'll increase the size of their balance sheet, so they'll start to buy buy Treasury securities again. And Chair Powell talked about that in his press conference. He's talked about organic balance sheet growth. So the balance sheet will start to grow again. And the second thing that they're going to strongly consider, I think, is introducing a standing repo facility. So whenever there's upward pressure on rates, there's a facility that people can come to and do repo with, and that would sort of take away any risk of a big upswing in short-term.
Many people